Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. Yet again, the market continues to move higher, this time with a gapping move higher over last weekend. The move up was originally prompted by the combination of the springboard of the optimized February to October 2021 head and shoulders top neckline, currently at 1224, and a September to December 2021 lopsided diamond pattern. These two, especially the lopsided diamond pattern, were an effective counter to the monthly key reversal down seen back in November last year. Yet this bullish counter has turned out to be so much more. The move higher from mid-December broke up over the resistance of the medium moving average, currently at 1319, the long moving average, currently 1359, and then the important 50% Fibonacci line of December 2020 to May 2021 move at 1405, converting all of them into supports. Now, we did see some hesitation from the end of December last year until 2 weeks ago, but it was very much the case of 2 steps up and 1 step down during that time, forming a small bull channel in the process, which we broke up and out of. Last week, prices punched up and through the first real resistance beyond this bull channel, and that's the 2014 high at 1522, which seemed reasonable at the time, but in reality, the market didn't even pause there in its rise. Prices then halted at the end of last week at the next band of resistance between 1571 and 1578, which has within it the November 2012 high at 1571 and the June 2021 high at 1577. This would also tie in with a move higher from the recent bull channel if we look at it as a bullish halfway hesitation. Beyond the resistance between 1571 and 78, we have the congestion at 1615 and 1685 with the 2021 high at 1667. However, there are 2 additional trend lines that need to be considered. The first is the extension of the bearish bump and run reversal top trend line, currently at 1626 from March to June last year. This is not that strong a resistance, but it's worth noting. The second is a more heavy-duty piece of work. It is the neckline, currently at 1615, of the big irregular head and shoulders top form between 2010 and 2014. Its sheer multi-year size offsets to a great degree its age. Meanwhile, looking below, well, I have already listed earlier prior resistance has now become support. Well, to this I'd add and also look at the first point of significant contact, the extension of the upper channel line of the halfway hesitation, currently at 1479. This seems reasonable right now. Overall, there is the beginnings of a big question that may soon be posed. Is the action from the 2021 high in May at 1667, is it one of the following? And if it is, which one would it be? Okay. There are right now 3 possibilities. A rounded bottom, a large cup with handle pattern, or a scallop pattern. This way may well be the most interesting thing to find out in the coming weeks. Chicago soybean meal. The key feature here for many weeks, and one that has been in effect since late November 2021, is the October to November 2021 bullish Andrews pitchfork. The upper tine, currently at 471.60, had and has capped the market throughout, with the middle tine, currently 446.10, acting as both support and resistance, and the lower tine, currently 420.5, acting as support, but getting during late January, getting pushed through. So why have I still kept this broken Andrews pitchfork on my daily chart after its evident breaking? Well, when the lower time was broken just below was the 50% Fibonacci line for the whole of the 2021 action at 390.40. And it was this that stopped a full exploitation of the break lower and indeed turned the market back up and back into this now broken but still effective bullish Andrews pitchfork. The move up 3 weeks ago also allowed me the opportunity to draw a fresh new bullish Andrews pitchfork for the late November 2021 to late January 2022 action, which is at a slightly steeper angle of attack. Last week, prices moved up and over the previous early January high and hesitated for a while at the crossover of both middle tines of each bullish Andrews pitchfork, something I'd warned about at the middle to end of last week mainly. That's before gapping higher over this past weekend. Since then, bar the action on Tuesday, we've had a straight run up in an area that is fairly clear of resistances, bar the May 2021 high at 457.20, which the market shot up through with ease. So where are we now? We are now testing the 2021 high at 471.40, as well as the upper tine of the original October to November 2021 bullish Andrews pitchfork, currently at 471.60. This is a key moment, as just above we have target X. We've had it now for a couple of weeks in the 475 even area. This target is derived from looking at the action since late November last year as a bullish halfway hesitation. Now, it's not a perfect target. However, this market has some pedigree in this, as it formed a similar, if smaller, pattern between mid-October and late December last year. Beyond this, we have the congestion in the 478.60 to 479.30 area, with the June 2014 high making up the top end of the congestion. We then have some congestion in the 490 even area before reaching the 2014 high at 494.40. In all this while, we still have the upper tine currently at 483.20 of the more recent and acute bullish Andrews pitchfork, rising by about $2.30 a day, each trading day. Now, one final point. I note a new event about to happen. It is a lagging indicator, but nevertheless, the rising medium moving average, currently 368 even, is about to make a golden cross over the rising long moving average, currently 369 even, in the next few days. Chicago soybean oil. The recent major feature here has been, and still is, the mid-December to date bull channels. The original and narrow of the two, currently at 66.89 to 68.69, worked well until early January when the market expanded to a larger bull channel. It reasserted itself between mid-January until this week, when the market once again expanded to the larger bull channel. I've kept the broken lower bull channel line on the daily chart because, as the market utilized it twice already, it would seem reasonable to hold it nearby just in case. The newer, wider bull channel still utilizes the upper bull channel line, currently at 68.69, but as a wider and lower bull channel line, currently at 63.03. This lower bull channel line was verified as recently as yesterday when we saw a bullish thrusting pattern pushing up off the lower bull channel line. Now, last week and the start of this week, we saw a halt to the rises at what I had pointed out over the past 2 weeks as the next congestion in the 66.45 area. The congestion was added to last week with a number of indecisive doji crosses and a spinning top as well, tying in with a late July high from last year. I've said for 2 weeks now that with no other major patterns operational at this time, apart from these two bull channels, though I was and am still mindful that I could draw bullish Andrews and shift pitchforks to the action since December last year. However, I choose not to, as these would be very, very narrow pitchforks and likely of limited use, perhaps only good for timing and with nothing really better to offer than what the two current bull channels can offer now. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware there is a disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.